Good afternoon and welcome to FBN Charting Points. My name is Brian Como, and today is uh, the 12th of the 12th of September. It was USDA Day today, so we got a lot to talk about. I tried to distill kind of the main points down here into some usable um, usable formats here. So I do want to start, of course, with a disclaimer as per usual. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material provided is on an as is or for informational purposes only and is not intended to be a substitute for specific trading, legal, or tax advice. Neither FBN nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability, therefore, is expressly disclaimed. Past results are not necessarily indicative of future past results are not indicative of future results. All right, so let's get into it here. I did want to talk a little bit right out of the gate about Statistics Canada's estimates. These just came out today, so we want to talk about them a little bit here and a little bit of a expectation of change from even a couple of weeks ago. So the last report, I think, was August the 29th, and so there is a new one being dropped on September the 14th here at 7:30 in the morning. Here's the estimates. We've got an average estimate for 30.4 of all wheat. That's versus 29.5 from that August 29th estimate. Durum 4.2, canola 17.9 million tons, oats 2.6 million tons, barley 8.5 million tons. Corn and beans, which are largely grown in Ontario, 15.0 and 6.7 million tons respectively for corn and beans. Lentils 1.8, flax 2.8, and peas 2.5 million tons. Now, just wanted to highlight a couple of things here. As you can see here, this is the expectation of change from August. So you can see here that there's a bit of a bias towards higher production, even only a couple weeks after the report. I think some of this has to do with harvest. We are hearing of some better than expected yields, even though they are still below average. Canola is higher, oats, everything is basically higher except the soybean number is unchanged, the flax number is unchanged. But everything else is pegged to be higher here, with wheat kind of leading the way. And canola is expected to be 0.3 or 300,000 tons higher as well. The barley number here also is a little bit surprising, as the market expects the Statistics Canada to report barley production higher by 600,000 tons. So there is a bit of a bias towards larger production, and likely which would add to supplies going forward. This is not unusual. We usually do see some of the lowest production numbers printed in that August report, and they tend to climb throughout the year, some more than others. Canola is the one that probably climbs the most from a percentage standpoint from its first production estimate in August until even the July S&D end, or even a few years after that. There is an average of about 1.5 million tons added to the canola crop over the next couple of years. So that's not to say this year will be like that, but that's just kind of historically what we look at. So there are some expectations of higher production. All right, here's some estimates for the yield for the production from the USDA today. Corn yield was reported at 173.8. That is about 0.3 bushels an acre above the average trade guess. And soybeans were reported at 50.1 bushels per acre, which was about 0.1 bushels per acre lower than the average trade guess. You can see here that the adjustments to production were pretty benign, though. The market, or USDA, reported 15.13 billion bushels of production versus an expectation of 15.11. And on the soybean side, USDA reported 4.15, which was a little bit lower than the average trade guess here as well. So, relatively benign numbers here, I would say, from the USDA. Maybe what I'll do is I'll kind of go into a per commodity thing, even though I'm going to talk about ending stocks and in the US and global ending stocks as well, but maybe I'll go through them on a commodity by commodity basis. It might just help kind of make it feel a little bit more put together here. So for soybeans, yield and production came in pretty close to expectations. So unless there was a whisper number that was positioned against, this soybean number would have been a non-event. We did see losses in the soybean market overall, but I think that has more to do with the global S&D. We'll get into that in a second. That still meant that 59 million bushels was taken off of production, which now sits at 4.146 billion bushels. On the demand side, some rationing was calculated, 10 million less crush, 35 million less exports, and all that shook out to 25 million less ending stocks. However, the ending stocks number was still 13 million higher than the average trade guess. So there is a little bit of a demand destruction or some demand rationing / destruction, depending on how you want to look at it, built into the S&D as well. So as we look at soybeans globally, which we'll get into in a second, 1 million tons of exports were added to Brazil, with the destination being China. There was 1 million tons added to imports there. Other than that, the world ending stocks barely changed, just some shifting of where demand is sourced, kind of away from the USDA or from the US and to Brazil, which may have caused some of the losses from today's market. Here's the US grain ending stocks, and I'll just kind of put this into the context of corn. So the US corn is pretty easy to communicate here. There was 800,000 acres was added, both to seeded and harvested. Yield was cut by 1.3 bushels per acre to 173.8, which was a little bit higher than the market was expecting. Not a huge difference, but there was 5 million less of ending stocks calculated for the 2022-23 crop year. So all that means that the supply of corn in the U.S. rose by 19 million bushels overall. Demand was left unchanged, so that 19 million went straight onto ending stocks. So from a U.S. standpoint, corn may be a little bit bearish. Global corn here is where it gets interesting. The market underestimated global corn ending stocks by almost 4 million tons, 3.87 to be exact. The market was looking for a cut, but they got an increase. 1.3 million tons of corn was found in Brazil from the 2022-23 crop or old crop. Could have been worse. The USDA added 2 million tons to production, but then backed it off with some extra domestic feed and increase in exports. For this 2023 crop year, the U.S. production increase amounted to about 0.59 million tons. Ukraine also added about 500,000 as well. In total, world production of corn rose by about 800,000 tons, but demand fell by about 600,000 tons. And then with the extra 1.5 from last year, that means almost 3 million tons of corn was added to ending stocks projections for the 2022-23 crop year. So that's the corn story. Today we saw corn. We saw corn sink about 8 cents a bushel. I'll get into some of the charting in a little bit here. Here's for wheat. There was no change to the U.S. balance sheet, so don't even need to really talk about that. Last year's ending stocks for globally, though, were reduced by 1.2 million tons on some increase to domestic consumption. Additionally, 6 million tons of production was taken out of the S&D, including 3 million tons from Australia, 2 million from Canada, and 1 million from the EU. So the three of those are actually pretty major players in the wheat market. Russian production was left unchanged at 85, which may have some head scratching, as many private analysts have the crop over 90 million. So that's a little bit of a flag there. Domestic feed globally was increased by almost 1 million tons as well. So that'd be wheat used inside of the countries domestically, which the aggregate of a bunch of those small changes in a number of geographies, resulted overall carryout of wheat fell by about 7 million tons. 5 of that was from China, however, so I feel the market may discount the Chinese numbers, although if you look at the market today, we did see some gains in the wheat market, and but that may be coupled with a little bit of sell the rumor, buy the fact in this case. So overall, I think this report was tilting a bit bullish for wheat. All right, let's get into what some of the charts look like. I'm going to start with canola, which sounds counterintuitive considering it's a USDA report day, but I think there's some very important things that happened here in canola today. First off, November canola broke support today, broke 757 support. That was a support line that we've been talking about in past videos, as well as in our morning audio commentaries. We have some more support perhaps at the 739 level, which is the 100-day moving average. But failing that, 694 on this chart anyway is the next charted support level, which would be the low in here. So this is the 100-day moving average in here. This is the next low after that. This chart looks very bearish now. There's no ifs, ands about it. There is some additional risk here from a technical perspective that could be added into the that you should be aware of here. I did want to kind of put on a Fibonacci retracement level. This 61.8% mark is one that we like to look at as well. As you can see, it kind of lines up with that low that we talked about back in the other chart, and some consolidation here as well. This could be a bit of a target area. You like my star. This could be a little bit of a target area for canola here. If you are not comfortable or cannot withstand a move down to that level, I would make sure that you have your risk covered in that regard. I do think there is still opportunity for this canola market. However, this is a big risk now, a test into this area, or even some lower trending over the next little while. I think what's happening here is that yields are coming in better than expected across much of the prairies. And I don't think that's necessarily creating a panic selling drive, but I think what it's doing is allowing for the realization that, oh, I'm not up to what I thought I was from a recommendation standpoint, or where I wanted to be at this time of the year, or maybe you're because of the over or underestimate. There's a bin space issue coming into play. Whatever it is, there is a bit of a push for delivery and a supply push onto the market, and that is creating some weakness. This isn't necessarily outsized from a seasonal standpoint. It's just happening a little bit later than we normally see. We normally see this market kind of bottom into the beginning of September, but on a longer term seasonal charts, it does tend to bottom in the end of September, the beginning of October. So we might be seeing a more longer term seasonal pattern play out here. Just to be aware, if you cannot stomach these losses, I definitely guarantee or definitely suggest that you be protecting yourself in this market. Just wanted to touch on a strategy recap from last week when we did our charting points video as well. These were the two options that we showed as indications last week Thursday. This was a put with a strike at 760. So as you can see, this option is almost in the money already. This would have only cost about $21.40 plus fees, and at that time the market was trading at 783. So this option would have already paid for itself in the protection that it would have supplied already for the losses that we've seen. Again, on the call side as well, a $24 call. You wouldn't have been able, this would have lost some value. But if you would have sold and reused a call, you would have had futures, locked in at 783 instead of today's sub 770, 761 value. So that's just kind of a recap from last week. I'm going to show a couple of ideas for this week as well. The costs of these have gone up a little bit now just to get a similar kind of protection. Here I'm pricing a 750 put in the market. And again, these are after the close, so there might be a little bit of a liquidity premium placed on the pricing of these here. Right now, the premium for that is showing 35.70. Again, this is a put with the market currently trading at 761. So about, $11 or $12 out of the money this option would be at this point. It would give you a 750 floor price. So if it is going to flush down to $7 or into that area, this would be good protection. However, if you want to maybe spend a little bit less money and kind of get a similar peace of mind, if you were to do your cash sale today for canola to protect your downside risk and add a call in at an 800 strike. So that means that you're back in the market. If the market rallies back above 800, that's costing you 26.30, or the indication here is for 26.30 today. And these are also, I should note, because this is important, that these ones from last week were quoted off the November, and these ones I am quoting off of the January. So the difference here is that the November only has about 4 or 5 weeks left until expiry. The Jan, you push that out until December the 15th expiry here. So just something to keep in mind. I think it might be worthwhile starting to look at the January. There is some volume that's going into that market as well. So some of the low volume premium is coming out of it. There might be a bit of an advantage to going to the July. Also, it gives you a lot more time with which a thesis can play out, and your time degradation isn't going to be as severe. So if something happens in the next couple of weeks, you still have a lot of time value in the January versus the time degradation in the November contract at this time. All right, I did want to touch a little bit on canola fundamentals again. I know I'm focusing a lot on canola here on a USDA day, but I think it is important here. The USDA did amend its canola production lower as a result of Statistics Canada's production release. However, what's interesting is that the USDA is at 18.2 million tons, and as we mentioned before, the Stats Canada report was 17. Can't remember off the top of my head now. 17 and change, 17.2 or some 17.4. The new estimate is 17.9. So the USDA is still projecting higher production than even the upgraded expectations are for StatsCan next week. So either they have a better grasp on what the Canadian canola crop looks like than we do, or they're just behind the eight ball and are not amending their production lower as quickly as they should be. That kind of transferred into global canola production, so that was also amended lower in in today's USDA report, now at 85.2 million tons. Previously, this was 86.1 million tons, so it is declining. However, also in this report, global soy oil and vegetable oil stocks were also expected to climb. So all of this kind of muddies the water a little when you want to think about directional bias on rapeseed, canola, and vegetable oils from a global standpoint, as it looks like the vegetable oil complex is turning a little bit more softer or potentially more bearish, even in the face of a tight canola market in Canada. Another interesting thing here is that the USDA did peg Canadian ending stocks at 1.2 million tons. This is a pretty low estimate, although I have seen estimates as low as this before. As you can see, the market does not take ending stocks down to this level very often. The last two times that we saw ending stocks this low was for 2001 and 2016, as you can see in this chart. Even my own estimates right now are a little bit above that. I have 1.3 million tons of ending stocks factored in for this year's Canadian canola. So although the USDA is expecting higher production, that is offset by the demand side, which would be crush, largely into the crush market. So anything that Canada produces extra really is likely going to get used by the crush market. I think the risk is probably somewhere in between the USDA's 1.2 million ton estimate and say a 1.5 or 1.7 like was reported last year. So we're probably going to see ending stock somewhere in that range between 1.2 and 1.7, I would say would be the top end for this coming year. All right, let's move into some of the U.S. commodities now. We did see a bit of a technical breakdown here in soybeans as well, which kind of broke below this previous low, as well as the 50 and 20-day moving average. This is the 200-day moving average here at 1330, likely going to go and test that level. These 100-day moving averages on these oil seeds, which are all lower than the other moving averages, is a pretty minor moving average trend line. I don't really necessarily look at that as being a major trend line. If we do break below the 200, I'm thinking we trade somewhere down into this 1280, maybe even the $13 mark. Maybe 13.0 would result in a bit of a mental area of support. But this chart is starting to look weak and due for a pullback as well. As far as where the money is situated here, soybeans are still net long, so there could be a long liquidation is possible in this market, as well as the other vegetable oil complex. Canola has probably got the smallest net long overall, but we were kind of getting up into some of the higher areas that we've seen in the last little while. So there is some potential for long liquidation in the canola market as well from a speculative standpoint. That may just add fuel to the fire if farmers are selling into this market as well. Corn did stave off. Look at the beautiful test of support here today. It did stave off breaking through that. A pretty tight range here, as you can see, with 745 support, 743 or 473, sorry, support down here, and this $5 area of resistance is probably a psychological one as well. If we can break above $5 here, that would give me some confidence that it might be ready to move higher, but it's been in a very tight range here for the last little while. If we do see the commodity index as a whole move lower, I think corn could be ripe for some more selling. But if we do see it go above $5, I would look at that as a positive. Chicago wheat started off having a bad day today. This new low was punched before the USDA report. We did end the day a little bit higher here. Of course, it doesn't look, bullish yet. No upward trend lines or resistance was broken in any way. But that's a pretty decent close for a day like today when it decided to push lower and ended up higher. You can see kind of the same pattern in the hard wheats as well. Kansas kind of rebounded from its lows today as well, and so did Minneapolis. Minneapolis did not make a new low, so there's a bit of a positive, larger positive spin on the Minneapolis market than in some of the others. There is also the opportunity of a bit of a short covering rally here, particularly in Chicago, which has been sold short as we were moving towards the USDA report this week. And I'm sure that short position grew into today. Today is the cutoff for this week's trading, for this week's reporting as well. I think overall we'll still see net selling into this week, even after today's little bounce. We also have hard red and hard red spring position short as well, not as aggressively. If we're going to see a short covering rally, I think it's probably going to come from the Chicago market. All right, that's all I had for you today. I know there's lots more to talk about. We'll get through it as we move through the rest of the week in the morning comments and the weekly market outlook and things like that. So look forward to those in your inbox later on in the week, and we'll see you again on Thursday. Thanks a lot. Bye-bye.